Hi everybody, I thought I'd do a follow-up video on my three-statement model video, just because I had a few questions about how to model net working capital. I really kind of glossed over that piece in that financial presentation. So anyway, cracking on, net working capital. So what this presentation covers, well, it's going to cover obviously what is working capital, broken into current assets, current liabilities. Within that, we're going to talk a little bit about the calculation basis required to interact the P&L, which is one of your three statements, to the balance sheet for current assets, and that's going to run through the main categories of current assets. We're also then going to do the same on current liabilities, and I'm going to add a little bit of kind of gloss of stuff to look out for if you're actually using these in the real world. And then finally, we're going to model that working capital in Excel. And as ever, there's a working file in the description of this video. So what is that working capital and where do you find it? Well, it's the current assets and the current liabilities. I've just taken a cut of the consolidated statement of financial position from Marks and Spencer's and I've highlighted it here. You can see though in current assets, I haven't highlighted cash and cash equivalents. Yeah, for financial modeling purposes, cash is not really part of working capital. It is the outcome of all of those interactions of working capital. So diving into the top half of the balance sheet, we have current assets, and well, I always like to think of them as the good things that a business owns. And I've broken down the main categories for our purposes, although I acknowledge there are other types of current assets like other debtors or accrued revenue. But for our purposes, I'm going to talk about stock, of which is split into raw materials, work in progress, finished goods, trade debtors, and prepayments. Right? And how this works is that what you do is you have a set of historical data, and what you need to do, for example, in stock, you need to find out what is the inventory days. Yeah, and the inventory days is how long, is a calculation method to work out how long a business holds its stock before it sells them. It's really easy to calculate. You get your historical data, you take the inventory at the end of the year, you divide it by the cost of goods sold, and you times it by 365 days to get your inventory days, right? You have to do that piece first, yeah, because the inventory days is extremely important. Then for financial modeling purposes, to get the statement one, so your cost of goods sold interacting with the balance sheet, yeah, you rework that first calculation into the cost of goods sold times by the inventory days, which you worked out from your historical data, and dividing it by 365 to give you the inventory on the balance sheet, right? That might not make sense to you now, but when we dive into the financial model and the working capital piece, you'll understand exactly what I mean, yeah? A point of note here is that it's extremely easy, especially startup businesses, to buy a load of stock and they hold it on their balance sheet for too long, yeah? And, you know, this is extremely important if you have goods which go out of date. Sometimes I think Beauty Pie, was one where my wife has a subscription for, and they sent her some free vitamins, very nice. And I said to my wife, I bet it's because it's going out of date. And when we looked at the date on the free product they sent, it had about 3 months to run. So they're obviously sitting on too much stock. They weren't monitoring their inventory days enough in respect of that line item. And so they tied up working capital within it. Moving on to the next one, trade debtors. Now, this is the big ticket item in most businesses, and this is where you sell something, but your customer doesn't immediately pay you in cash. And it's exactly the same, really, same methodology. We have a calculation basis, which we need to work out. We need to work out what our debtor days are based on historical data. And you get your accounts receivable, you divide it by sales, times it by 365, gives you your debtor days. You then rework that calculation by taking the revenue from your forecast, yeah, timesing it by the debtor days that you worked out and dividing that by 365, and that gives you your closing trade debtors at the end of that period. Yeah. So what you've done here is, again, you've worked out something from historical data, your debtor days. You then put it back into your forecast to give you your balance sheet figure. So then statement one, your P&L is now interacting and creating the balance sheet position. Just a couple of comments on debtor days, right? Debtor days should always be a KPI within the finance function. Yeah, if it isn't, they always get too long. So I always have it, and I'm always looking at it, and I'm always asking it. And the second point is probably here when you're modeling here is that you can often have different types of revenue, right? And so An example might be you sell 2 product lines, one in which an extreme example might be one in which your customer pays 60 days late, and another one, for example, your customer might pay 3/4 in advance. Yeah, in those circumstances, you really need to model 2 sets of debtor days of 2 sets of revenue, and that's because the vast differences in the collection rate between revenue 1 and revenue 2, one being effectively prepaid and the other one taking 60 days to pay, can be extremely distortive, right? So that's an extremely important point to know, so that when you have different kind of revenue cadences, break them out, do 2 separate revenue lines on your P&L and 2 separate trade debtors, and work out 2 separate trade debtor day figures to do that from historical data. Finally, the last one is prepayments. Well, prepayments are stuff which you pay in advance. They sit as an asset on your balance sheet. Often businesses which aren't doing well hide costs in prepayments. Yeah. So sometimes, sometimes I mean me, I've unbudgeted some spend. I chuck it to prepayments and I'll release it over the rest of the year to smooth that P&L. Yeah. And you model this with a schedule of prepayments. And what I mean by that is, say for insurance, you pay it once in the year, but then you model out 1/12 of that every single month being released to the P&L, and that's your prepayment schedule. So we'll talk about that as well when we dive into the Excel. So moving then on to the bottom half of the kind of balance sheet, and specifically the bottom half of working capital, we look at current liabilities, right? And I always think of these as bad news, right? This is the things that the business owes. And the first one is obviously trade creditors. And again, it's exactly the same. We use a calculation basis to interact the P&L or the financial statement 1 with the second financial statement, the balance sheet. And so we look at our historical data and we work out our creditor days, which is how slowly a company pays its suppliers. And you do that by doing trade payables at the end of the period divided by the cost of goods sold in that period times by 365, yeah, which is the days in the year, and that gives us our creditor days. We then again rework that formula when we go into our model, and we take the cost of goods sold from our forecast, we times it by the creditor days that we worked out, and then we divide it by the number of days in the year, and that gives us our creditor days on the balance sheet, right? And again, creditor days should always be a KPI of the finance function. From my experience, often a decent AP, and what I mean by a decent AP manager is someone who inherently doesn't want to pay people, which they nearly always are. They will manage creditor days themselves, right? And from my experience, they can often sit around 60, 65. Accruals. Now, accruals are items we need to pay, but we haven't received an invoice for. And a good way of thinking of this would be a business pays its rent in arrears quarterly. So in January and February, it doesn't get an invoice. And in March, it gets an invoice for all of those 3 months. Well, if we didn't accrue for it, if we didn't put that cost in the P&L, the P&L would look like rent 0 in January, rent 0 in February, rent 100k in March. Obviously, that's gibberish. So what you would do is you accrue, you debit the P&L with 33k in January, you debit the P&L again with 33k in February. So you created a balance sheet item there of 66k. When the invoice comes in into March, you debit the P&L for the full 100k, but then you release what you've accrued on the balance sheet at the same time. So the net cost in March is again 33k. And you model this like prepayments with an accrual schedule. So we're going to dive into the Excel now, and what I'm going to do is I'm going to show you just on some line-by-line items how those that historical data for those line items can be used to calculate your creditor days, your debtor days, and your inventory days. And then I'm going to show you with the working file how you plug those back into your forecast to create your balance sheet items. And then maybe, I don't know, I'll show you how that creates your cash position. Right, guys, thanks very much. Let's go into the Excel. Right, hi guys. As you can see here, I've made this file called working capital. And when you open it up, you see it's grouped at the top in columns. And we've got a forecast here but we've also got your actuals. And you remember your actuals are really important for modeling working capital, because that is how you get your debtor days and your creditor days. If you're starting up from scratch and you're modeling a startup, well, then you know your terms. So if it's 30-day terms, plug in 33, and if it's suppliers, you're going to be paid at 60 days, we'll plug in 65. Yeah, but you really want your actuals or assumptions, and then you've got your forecast going on here. So the forecast does the numbers where you're budgeting, how much sales you think you're going to get, but your actuals are obviously all real, right? And so to be explicitly clear, yeah, you will make up the forecast for your P&L, and that forecast on your P&L will drive your forecast balance sheet, which is down here, via those creditor and debtor days calculations, and it will also drive then from the movement in your forecast balance sheet will drive your forecast cash flow, which will then plug back into the cash flow here. But we're getting a little bit ahead of ourselves. So starting at the top then, I have actual revenue and cost of goods sold. I have actual balance sheet cash, actual trade debtors, actual prepayments, and actual creditors, right? And I'm going to use these actuals to calculate my trade debtors, so my creditor days, my debtor days, to give me the debtor days and creditor days that I then put into my forecast. Okay. So scrolling down here, you'll see working schedules beneath your third three-statement model. Going down, you've got your debtor days, right? And the debtor days is the trade debtors divided by revenue times by the number of days in the period. So in my original one, I did it annually, so I was timesing it by 365, but obviously because this is I'm doing it monthly, we're timesing it by the days in the month, right? And that's a clear distinction to make, which you must make, right? You're always timesing it by the number of days in the period in question. So looking at that again, trade debtors divided by the revenue in the period times by the days in the month gave us our actual debtor days for July. And once we've done it for one debtor days, we just pull that across and gives us that, right? And we do that for revenue too, again. So we have the trade debtors actuals for revenue too divided by the days in the the revenue sold in that period times by the days in the month. We do it again, and then we have the combined as well, yeah? And that gives us our actual trade debtors, right? Creditor days, very similar again. What we do is we have the trade creditors actuals, yeah, divided by the actual cost of goods sold in the month times by your days in the month, right? And that gives us our trade creditors, and we pull that across, and which gives us our balance sheet, yeah? So we have from our actual balance sheet, we've now modeled our trade debtors and our trade creditors, right? And all I've done here then is it's so straightforward, it's so simple. I've taken the average of those calculations there to give us our forecast trade debtors, our forecast debtor days, and our forecast creditor days, yeah? And you can see here, right, in the actuals, it was a calculation to get your to get off the balance sheet and P&L to get your debtor days. Well, now though, because I've got our debtor days, when I move to the forecast, when we look at the trade debtors on the balance sheet, you can see here that the formula's changed. I'm now doing the sales times by the debtor days divided by the debtors in the period, right? So can you see that here? Right, there's been a change, right? Because there's been a change from what I'm doing. I'm plugging in that actual debtor days that I calculated from my actuals back into the forecast P&L to give me the forecast balance sheet. And that's how you make your balance sheet, right? And so you do that for all of those items, yeah? Your trade debtors there, you do it for your creditors again, yeah? So I'm taking my forecast creditors, yeah? I'm timesing it by the creditor days that I calculated from my actuals, and then I'm dividing it by the days in the month to give me the trade creditor balance in my forecast, right? And you do that for your trade debtors and you do that for your trade creditors, and that it is as simple as that. That is how you build up your balance sheet, yeah? You work out your trade debtors from your actuals, and then you plug it back into your forecast P&L to give you your forecast balance sheet. So then moving a little bit further on, you'll notice that there's a prepayments, and I discussed this, right? Well, prepayments
even easier, right? So I've got a prepayment schedule here, and you can see opening balance, and you can see some items which are things which enter into that prepayment schedule, right? So we say here we're open July 21 with an opening balance of your total prepayments of 500 quid. Okay. Sorry about that. I got email sent to me. I got totally distracted. So as I was saying though, all this is the prepayment schedule. It's really straightforward, right? Opening balance was that, and then what we're saying is we're releasing 48 quid, then it builds up again in September with another 97, invoice paid in advance relating to 2 months, invoice paid in advance relating to 2 months. So you can see here, you actually have the schedule, right? So when you get to the end of this, right, you can make the forecast really straightforward, right? Because you know what's happening, right? You have the actuals at the end of June, and you know, right, well, insurance, well, I know that's over 2 months, so I can forecast it out again like that. And you get there. Copier, well, you know that you're getting from looking at the historical data, it's every 2 months, so you can bring that in again. Same with the rent, same with the service charge, right? So forecasting your prepayments is the easiest thing in the world to do. Add up the total 791. Yeah, you just plug that back into your balance sheet there like that. So it's the easiest thing to do, but it's an item of your working capital. And then that means, right, what we've done here is from our P&L, we forecasted our trade debtors. From our cost of goods sold in our P&L, we forecasted our creditors. Using actual data from debtor days and creditor days, we backward rework those formulas to give us our forecast balance sheet. We've got our prepayments, which is really straightforward because we've got our own prepayment schedule and we've looked at the historical data, and that's allowed us to create our look forward prepayment schedule. The last thing that we need to do, which is obviously missing, is our forecast cash. So how do we do our forecast cash, right? Well, once you've done your debtor days, your creditor days, right, it's really easy to do your forecast cash. Right, and what we do it by movement in net working capital, right? And so on this, beneath this, the third financial statement, which is the cash flow, right? You can see here I've pulled in the actual data from the balance sheet for trade debtors, the actual data from prepayments, and the actual data from trade creditors, right? And that is your working capital. And if you recall in the PowerPoint, I said we don't really treat cash as working capital, and this is what I meant, right? Cash isn't in here, yeah, because it falls out of the movements in working capital. And so what we've done here is we add up all the totals, so we add up, and that gives us our net working capital, and it's the movement in that net working capital that we're interested, right? And we always do prior year minus current period, yeah, prior period minus current period to give us the movement in our net working capital. And we take that and we plug that back into our cash flow here. So you've got the movement in the net working capital, you have your opening cash and your closing cash, which is simply the movement in your net working capital, plus by your opening cash gives you closing cash, which you plug back in to your balance sheet. And you can see then the whole balance sheet balances, right? And that's all you have to do. So if we move to the forecast, right, let's look at what's happening on the cash flow in the forecast, right? So again, we've taken the trade debtors, we've taken the prepayments from our forecast. The trade debtors in our forecast was worked out by looking at by applying the debtor days from our actuals and pushing it back into our forecast P&L. That gives us our trade debtors balance. Again, prepayments, we've got our schedule forecast which we've made. Trade creditors balance, well, that was made by taking our creditor days, reworking that formula, and then plugging it into our cost of goods forecast to give us our balance sheet item for trade creditors. We've done that. We then add up all of those items to get our net working capital movement, which we then plug into our cash flow, right? And so the opening cash in our forecast is obviously our actual figure from the closing cash. We then have the net working capital movement from our actuals to our forecast, yeah, of minus 19k. We add that to our opening balance of our forecast, which is obviously the closing balance of our forecast of our actuals. We add them up and then just pull that along, yeah. And that's doing exactly the same thing every single time, taking your net working capital movements, adding it to your closing balance. We plug that back into our that cash line, then back into our forecast from our cash flow, and and your balance sheet balances, right? So you modeling your cash, you don't really model it. You model it off your working capital, but it's the last item you plug into your balance sheet when you're doing your forecast, and that's how you know it works, right? Because as soon as you plug it in, it should all resolve. Yeah, your balance sheet should balance. And obviously, as I've said previously, there's the other check to make sure that your cash balance on your cash flow ties back to your balance sheet cash. All right, guys. Well, I'll make this working file available again, and as I say, hopefully that kind of brought into sight how you actually use those working capital items in a bit more detail. Yeah, you can play around with the spreadsheet, but as I say though, it should now be really straightforward. But any questions, do let me know.